Hey everyone, this is Kirk here again at OptionAlpha.com and welcome back. Thank you so much for checking out this video review that we do here each and every night on the membership side of our blog, where we actually go over all of our opening trades and closing or adjusting trades each and every night. So these trades are actually for Friday of this week, and I'm recording this video on Saturday because it's the weekend kind of video. So we had a lot of activity on Friday. It was actually one of our more quiet midweeks that we've had in a long time. We're usually making trades at least every other day, a couple trades here and there. And Tuesday and Wednesday, Thursday was very quiet. Wednesday, Thursday, we didn't make any trades at all. And then Friday, we just had a ton of orders that got filled. A lot of orders got filled early in the morning as stocks jumped lower. And then some in the afternoon, and then others at the end of the day. So it was a very, very active day, but we'll go over all of those. Really, the whole idea here is that we have now a huge opportunity in front of us. Volatility has gone up across the board. And for those of you who follow these videos, you know I've been saying now for about a week or so that even though the stocks have sold off, we haven't really seen that jump in implied volatility in the actual stocks, right? So the market sold off and stocks have sold off, but we haven't really seen that uptick in implied volatility where now we see a lot of things that have much higher implied volatility. So we're going to jump back into a lot of this stuff, and more or less April is probably going to be one of those months that's on the losing end. And so we had a lot of trades that went well, but we had a little bit more that went, bad. And that's just what you're going to get as part of trading. You're not going to have every month that's a winner. But I'm really, really excited for what's coming in May because we have such a great opportunity to put on some great premium and a lot of high probability trades. So I'm going to go over those tonight and then talk about also some trades that we closed out as profits. We're going to continue to do that all through next week, which is expiration week for April expiration, and look at rolling some trades. I think it's going to be a good month to roll trades to the next month, so we'll talk about those and obviously send out alerts to only our members. So the first one I want to go over tonight is DIA. So DIA and JCP, which is JCPenney, are very much of the same breed of strategy. So that's why I put them here together so we can go over those together kind of side by side. And the whole idea here is that while we do think that the market is a little bit oversold and could be due for some sort of a bounce, and we want to obviously prepare for that. We don't want to be caught with our pants down and the market just rallies away from us and we didn't have anything on and no positions on to profit from. While we do think that, we also want to be cognizant and aware that the market could continue lower. So these are some of the trades, as well as some other ones that you guys will see below, that we also put on that take advantage of the market going down. So DIA is probably one of the best ones. It's more of a general broad hedge against the market going lower, which is why I liked going into this trade on Friday. So what we did is we bought the 163 puts, and then we went 4 strikes out and bought the 159 puts. And we paid a debit price of about 180. So the whole idea with going 4 strikes out, because I got a lot of emails about this on Friday, was nothing more than just widening our strikes so that we could sell less of these vertical put spreads and therefore tying up a lot bigger chunk of capital with less commissions. That's all we were trying to do here. We could have easily done a 65, 64, something like that, $1 wide debit spread. But the whole idea with this one is that we wanted to get some broad exposure. So what we did is widen out our strikes. We'll still try to keep the break-even price right around the market price, which is what we did as the trade was entered, but then have the ability to widen our strikes, use some more capital with less contracts, and therefore save a little bit in commission. So a good little way to save a little bit in commission. If we go to the actual chart of DIA, you can obviously notice that it's just continuing to make lower and lower lows. And really, DIA has started to really break out lower. So at the beginning of the day, it looked like it could rally back up, and we did see a nice little rally that the market put together. But by the end of the day, we actually saw stocks continue to move lower, and it closed virtually at the lows of the day. So this is going to give us really, really good broad exposure to a downward move in the market, which is what we need to help hedge some of the other positions. If I actually go to the trade tab here, you'll notice that our position is obviously down the bottom right and left-hand corner. We're up $40 on the day, so that's obviously good just in one day of trading. And you'll notice where our strikes are. So our first strike is at 163, and then our bottom strike is at 159. Now again, when we actually entered this trade, we were trying to straddle the market around 161 or so. That's around the price that we were trying to kind of get our break even very, very close to. And we got fairly close to it with a buy price of 180. So we're very close to our break-even price there, so it's obviously working in our favor now, and it's going to continue to act as a hedge going forward. So we just want to keep that in mind. If we go over to JCP, JCP is another one that we saw on the screen on Friday and said, you know what, this one's one that could definitely use a lot more lower movement and could probably get there pretty quickly. So that's the reason that we jumped into this. It did not have high implied volatility yet, so if it does, that will obviously help our position, but we went ahead and bought the 9.7, which is a $2 wide debit put spread, and we paid about a mid price around that as $1.10. So not exactly mid price at $1, just over mid price at $1.10. If we go to JCP, on the chart here, you can see just how aggressive the sellers were in JCPenney on Friday. Notice that huge red candle. So I think that even though the stock had a nice gap up down here at the beginning part of February, I think we could easily hit the $7 mark here in the next couple days, which is really my target for this thing right now. So if we get to the $7 mark, we should see a pretty significant uptick in our profit that we have in JCPenney already building. Now again, it's kind of odd because usually when we get a huge down move like this on a lot of selling pressure, we see a big move up in implied volatility, and that just hasn't happened yet. So because of that, that allows us to then buy that debit spread and hopefully profit from not only the directional move of the stock, but also an uptick in implied volatility, which would be great for our position. All things being same, if JCPenney stayed right here and implied volatility went up, then our position would likely make money. So that's obviously going to work in our favor if it does, and if it goes down, that's okay too. We just want the stock to continue lower. It's much more of a directional play than it is a volatility play. All right, so let's get into some of the credit spreads that we sold. So we sold a set of basically 3 different credit put spreads, and they all basically have the same mentality, is that implied volatility was very high on all of these things, and we wanted to get into these things with a bullish directional bias. So you'll notice that the Qs are one of them, and so we're pairing up the DIA with the Qs, trading a little bit non-directional here. And with the Qs, we sold the 82.80 put spread for about a 40-cent credit. So it's a little bit less than what we wanted to get, but it gets us far enough away from the market to be a little bit dangerous in how we position, not dangerous in a bad way, but dangerous in a good way, in how we position ourselves for further moves. You'll notice that implied volatility for the Qs right now is up at the 100th percentile. So while I don't really think it's really 100%, I know that it is the 100th percentile going back about a year on our charts. I think implied volatility can go much higher than here, so this would obviously stay at the 100th percentile for a while, but that just really bodes to this idea of selling premium when implied volatility is high. So by selling premium now, we got ourselves down to around 82 as a first strike. Our break even brings us around 81.50 or so, so that's obviously good. It gives us a lot of room between us and the market for the market to continue to fall, and we would still make money on this thing by May expiration. So that's the whole idea here, is that we're going to catch some sort of little bounce here and get out of this position before May expiration. But if we have to hold it, we'll hold it all the way to the end. Yahoo's another one that we got into for May. So Yahoo is one that we actually have a big iron condor in for April expiration, which is coming up next week. But again, we can't just go on with April expiration and not add positions for May. It's just too good of a position, too good of implied volatility to really shy away from. So we went ahead and sold the 31.30 credit put spread for about 30 cents in credit. That's about exactly where we want to be usually with our credit put spreads, is selling that premium for about 30 cents. And for Yahoo, I'll go to that chart so you guys can see it too, has had a really up and down kind of last couple weeks. And you'll notice that it just kind of tries to rally and then it falls, and then it tries to rally and then it falls. It was actually one of the rare stocks that actually closed up on the day, even though it was down overall. It actually closed up on the day, so it still opened lower than it closed. It closed up on the day and kind of won the day, as I call it. And so that really bodes well for the stock. We do have earnings coming up, which will be a huge mover for this thing coming up next week on Wednesday, I believe, or Tuesday, whatever the case is. But again, because of just the directional move in the stock, I think that at some point it's going to have some upward mobility. And notice that high implied volatility at 97th percentile, which is more or less because of earnings coming up. So after we get past earnings, we'll definitely see a drop in the stock's implied volatility. So if we just happen to catch the right directional trade here with Yahoo earnings, that's obviously going to help us both in direction and in a drop in implied volatility. Amazon is virtually the same way. Amazon is one of those ones that's a very big stock, but just recently had a nice jump in implied volatility. It's actually not a stock that has typically high implied volatility. It kind of comes and goes in waves throughout the year. So we went ahead and sold the 290, 285 debit or credit put spread for a 137 credit on those, and we just sold 2 of those contracts. So 290 was our first strike, and that's obviously the one that we care about the most. If I go to Amazon, you'll see Amazon has had a really, really tough time as well. But you'll see that our actual strike is down here below the chart, so about another $20 below the chart here at 290. So again, we have the same thing here with Amazon. We have earnings coming up very, very soon, so that's going to be on the radar for us as well. And implied volatility up at that 99th percentile. We have so many stocks like this right now. You just cannot shy away from this. Now, we also have a debit call spread for Amazon as well for May expiration, so that's going to be working in our favor as well. So we're kind of ultra bullish on Amazon here. So earnings is going to be a big one, and we obviously definitely want to see Amazon rally here in the next couple of weeks. But hey, you got to make sides and pick sides and pick positions as you see fit. All right, so the next one that we want to go over is V, and V is Visa. And I know a lot of people got confused because it's only just one ticker symbol here, one letter, and that's V. But go ahead and type it in, it's Visa. And in this case, what we did is instead of adding another bullish position, getting overly bullish, what we did is we added some call credit spreads to the market as well. So you'll notice that in the trading Friday, we were actually a little bit more bearish than we were bullish, except some of our bullish positions were a little bit wider, and we sold more contracts and therefore took up more capital. So you'll notice that we're actually very, very neutral in how we're adding positions to this portfolio. And I just want to stop here and say that you have to do this as an options trader. So you can't be one-sided all the time. You have to add positions that are both bullish and bearish, because at the end of the day, we don't know where the market's going. We're just making directional assumptions. And as long as they're high probability trades, we're going to have an opportunity to close these things out at a profit at some point. And the key is always just understanding and recognizing when that opportunity is and getting out of the trade, right? So at the end of the day, we added that position in Visa and then BX. The position in Visa is we sold a 205, 210 call spread and took in a 123 credit. So we went ahead and sold a position against Visa, saying that Visa might continue lower as we get towards May expiration. So if I go to Visa, you'll notice that this is actually one that looks very similar to a lot of the charts that we're already looking at. Amazon, the Qs, DIA, etc. is just this huge, huge downward move. And while on the outside it looks like we should get bullish on this, we don't want to get overconfident in thinking that everything is making a bottom, right? So still has a high implied volatility. So we went ahead and sold the 205, which puts our break-even price or our break-even line in the sand kind of right around 206 or so. And so we're giving ourselves a little bit of room for Visa to bounce back up here. But obviously, if it continues to move lower and implied volatility drops, that's obviously really, really good for our position. Since this is a little bit different from what we usually do with some of the debit put spreads, I went ahead and let's go in here and just take a look at the actual trade tab here. You'll notice that our strikes here for Visa are right out here at 205 and 210. So it's about a $5 wide strike, or a $5 wide spread. And notice that the first strike has about a 30% chance of being hit, or a 30% probability of being ITM or in the money by expiration. And so if we flip that around on the other side, if we kind of reverse that probability, if it has a probability of being 30% loser, or a 30% chance of being a loser, that means that it has on the other side a 70% chance of being a winner by expiration in May. So this is a really, really high probability trade, and a lot of the trades that we're making right now are high probability because implied volatility is high. It allows us to go further out and collect a better premium. So we're only down 24 bucks on this trade, which is basically nothing right now. It was just movement in the stock at the end of the day that kind of rallied up against our position, but that's okay. Still trading with about 70% chance of success on this trade, which is a really, really good trade. I'll make these trades all day long, all year long, and at the end of the year, I'll be very, very happy because at the end of the year, I'm going to have 70% winners, 30% losers, and make more money on the winners. Okay, let's move on to BX. So BX is Blackstone, and they've had a huge, huge quarter as far as just making it just really, really tough for investors. What looked like is going to be a huge breakout year for them has really been a tough couple of months for BX, and just continues to make lower lows and lower lows. And so because of that reason, we went ahead and sold the 30-31 call spread against it, took in a credit that was just less than what we typically like to take in, of about 30 cents in premium. So we took in about a 27-cent credit on this one. But when I go to the chart here, you guys will see that it's just having a really, really tough time kind of gaining some ground. So we think that it'll continue to move lower. Now, it did rally off the lows here at the end of the day, but we have earnings coming up, and they're not expected to be very good for Blackstone. So you'll notice this kind of head fake that the stock did, where it broke out here in the beginning part of March and looked like it was going to go off to all-time highs, and then just continued to just have real trouble making newer lows and lower lows and lower highs, obviously just kind of folding obviously all the way down. So I think at some point we might have the stock rally up a little bit more here, but at the end of the day, this is one that I'm definitely betting might continue to move lower as we head in towards May expiration. So right now, since we sold the 30-31, we're about 14 cents in the money, which is okay. That's just because we actually sold this thing while Blackstone was at the lows of the day. Just bad luck in selling it at the lows of the day. The stock rallied back up at the end of the day. So hopefully this won't continue, and as we get closer to earnings, implied volatility will absolutely 100% drop after earnings. That will obviously help our position, and if we get a good move lower in the stock, then we'll obviously see a nice little profit. All right, so let's go over some of the closing trades today. So we had 4 closing trades today, and again, with all these closing trades, what we're trying to do here is try to close out these trades early, especially with some of these trades that are more directional in nature. So COF, which was OIH, which was a pure 50-50 bet originally. We had just made a directional debit spread trade on OIH, and at this point, now that OIH moved a little bit lower, you got to close these ones out a little bit early. You can afford to wait a little bit on things like credit spreads and iron condors, things that you have high probability moves in your favor, but some of the other ones, you want to close them out early. That's actually statistically proven to be the best way to manage these positions, is to close them out early versus waiting all the way to expiration. But again, like we say here a lot on Option Alpha, is that if we don't see a profit early, or at least a profit that we want to see that kind of covers commissions and things, then we will hold those positions all the way to expiration, even if it becomes a full loser. And over time, we've been here for 7 years, that continues to prove out to be the right way to do things. Statistically, it is the best way to manage your positions, and I know it doesn't make sense on the outside, but that is the best way to do it. And again, if it didn't make sense, or if it made sense and everyone did it a different way, then a lot more people would be making money, but they're not. So let's go over XRT. So XRT was one that I really like this trade because we kind of held on all the way through all this kind of turmoil in XRT. It kind of popped up as soon as we made this trade back last month. So this is one that we've had for a little bit now, and we went ahead and bought back our credit spread that we sold on the top side, so our call credit spread, the 85.86. We bought it back today on Friday for a 20-cent debit, which is a $12 profit. So not a huge profit per spread, but when you look at all the 8 spreads that we sold, it was actually a fairly decent profit for the sides trade that we made, considering it was only a $1 wide strike. So for XRT, if we actually go to that, the retailers have been having a real tough time. And like I said, when we actually bought this thing or sold this thing back here in, I believe it was in the beginning of March, we had this thing go right against us the whole way. And we've kind of held our ground the whole way, just watching this thing go all the way up and then come all the way full circle, all the way back around. And it's just a real good testament to just holding on to these positions, because you're going to have an opportunity at some point to take a profit. Now, implied volatility has jumped up, which really just kind of inhibited the position from really gaining all the full profit that it could potentially make. So it was much more of a directional move that led to the profit than a drop in implied volatility. So this one's now back on our radar, though, as something that we could actually sell a credit spread in, or possibly an iron condor, etc. So we're just going to kind of wait it out here, and this one's definitely on our radar coming up here in the next couple days. COF, so financials obviously had a really, really tough day, kind of led the charge lower on Friday, and Capital One was one of those ones that continued to move lower. We actually went ahead and bought back our call spread that we had originally sold, the 82.5 vertical call spread, bought it back for a 20-cent debit, made $33 on each individual spread. We bought back 3 of those spreads. So again, a nice trade, good profit on this one. Really, again, this one is because financials had a really tough day on Friday, Implied volatility is still very high in financials because of the move that it had, but Capital One's another one that we had originally sold and went right against our position, and we kind of held strong. Again, no stop losses. This is where a stop loss would have gotten us out of the trade at kind of full loss, very close to a full loss, but you just kind of hold strong, and this thing made a just U-turn, just like a lot of things have done, and nobody saw this coming in a lot of these things as it just continued to move higher and higher. So this U-turn that it's made obviously is really, really good for our position and allowed us to then get out of the position with a very, very healthy profit early on. All right, so the other one that we already talked about briefly, but we'll cover again here, is oil. So we originally bought a debit put spread, the 52.49. We went ahead and sold that back to the market for a 195 credit per one. So we made a $62 profit per spread that we sold back. So we sold back all three of our spreads. So it was actually a very, very profitable trade for us. And really, oil just continued to move lower with a lot of the general market here over the last couple of days. So this obviously has helped our position. We actually have only been in this position for a couple of days. We had, if you go back to a lot of the video archives, we actually bought this spread this day right here where I talked about this huge shooting star pattern. And so this actually turned out to be a really, really good timing trade. It was just dumb luck. And again, you'll be the first to understand that I always say this on this blog. I'm not going to ever say that I always pick every top and pick every bottom, but it's just dumb luck, and it is what it is, and sometimes we like to get that, right? That's why we make the trades that we do, and we keep trading consistently. We're going to have these where we just kind of pick the market at the exact right time, but this shooting star pattern was a real tell for us going into that trade, is that the market rallied all the way up and then came all the way back down in the same day. So just really goes to show you how many people sold this thing off after being so much higher in the day. And obviously that's led to much more selling pressure in the oil sector going forward. So we got rid of that position and exited that, and so now we're out of oil pretty much completely. And the last one is Pfizer. So we bought back our vertical call spread that we had originally sold in Pfizer, bought that back for a 10-cent debit, which is about as low as it's going to go for May. So for another 10 cents, I'm not risking holding this thing all the way through May expiration. We made $15 profit, which is much more than we had intended. So it's much more than the 50% of max potential gain that we target. So that $15 profit was on all four of the verticals that we bought back today. So Pfizer was a really, really good trade. Just a quick move down the stock. Again, I don't think we were in this thing much or very, very long. And you can just notice how quickly Pfizer continued to move lower. So that's really, really helped our position, that directional move in Pfizer. And obviously, implied volatility is now back on our radar for Pfizer as a potential candidate for getting back into this trade coming up. So that's exactly what we want to do. We want to be very nimble in how we trade things. Once we get out on one end, then we might look into getting in on the other end, etc. This is a pretty big move for Pfizer, so I don't expect this stock to continue moving much lower. And in fact, it's hitting a very all-time area of resistance and support going back many years. So this might be a good area to get into something like a credit put spread, or possibly an iron condor. We do have earnings coming up, so we know that implied volatility will crash soon. So possibly we might want to get into a trade before that and take advantage of that drop in implied volatility after earnings. So as always, I hope you guys really enjoy these videos. If you have any questions or comments about the trades that we made here today, add them in the comment section below this video. And if you're watching this on YouTube and you're not a member of OptionAlpha.com, you got to get on the membership there. It's a free 7-day trial. You only get these trading alerts and videos when you sign up for a membership. So if you're watching on YouTube and you're watching this video, you have to understand that you're actually getting this video about 7 to 10 days after it goes out to our members. So you can't take advantage of any of these trades. You can't make any of these new trades or close out any of the trades that we obviously had that are existing. The only way to get this exclusive content is through the membership area on OptionAlpha.com. As always, hope you guys really enjoy these, and happy trading.